Well, good morning. We're going to go ahead and get started. We have a number of participants that have already logged in, and I've had a couple of text messages, people who can't make it right away, so we'll let them join us. This is going to be recorded and available later, so Ryan will give you instructions at the back end of the event today. Well, some of you remember 6 years ago or so, we met at the Holiday Inn at 7 o'clock in the morning for the first Roundup. About 30 of you were there, and it's grown to well over 200 today in a virtual broadcast. So what a changing world we live in. We're not here today to give you any coronavirus precautions, that kind of thing. I think there's plenty of information out there about all the things that we all individually need to be doing. But first of all, I'll let you know our entire team is well, working from home, as well as some office participation under all the standards we need to observe. But we're busy every day. We're working on some contracts. We're working on new listings. We've filed some new listings. We're out doing aerial photography on some of our properties. And so we're alive and well and doing fine. And we hope that all of you are as well. I want to thank my entire staff and team to help put this together. So, good thing that real estate was deemed essential. And even though we're working under some curfews and other restrictions, it's a little bit deadly shift for us. So we're here too. If all you want to do is just give us a call and talk about what we're seeing going on in the shifts, so we can provide some service to you as this world evolves. We're here to help too if you need some discussions about valuations or book value or dispositions of assets in this reset world of fundamental changes. I'm an old veteran of the RTC days, the veteran of all of us in our team from '08. So we've seen a little bit of it and been around a little. So we think we're ready to deal with what's coming next. Don't know what it is yet, but we're certainly trying to be geared up for it. So the best from our team to you. Last year, I got to talk about for just a second, it was such a great year. Best year we ever had as Eshenbaugh Land Company. And we had all these wonderful things going on with job growth and new migration, housing shortage to some extent. The existing home prices had not gotten out of control in Tampa Bay. Extremely low interest rate environment. And 129 months of growth. It was, we kept asking ourselves and pinching ourselves, when's this going to be over? That was a 10-year run, almost 11-year run. Didn't realize that it was going to end so abruptly. This has been as sharp a downturn as I've ever seen. But we had lots of tail winds going into March. And we kind of used March 16th and March 17th as a dividing line. We closed several transactions in the first quarter, right up through, including on March 16th. But on March 17th was the first day that we had a residential land contract that said, oops, don't want to close right now, need an extension. So we'll talk a little bit about how some of that's worked out. But at that time, up till that date, we had a lot of good strength with apartments were really strong, healthcare super strong, closed 2 hospital deals in the last year, as well as non-partial. Industrial was just out of sight here in Florida, 15 million square feet of new space along the I-4 corridor. We're a hub of distribution for today's world. And of course, some of the other disciplines, even self-storage and senior care, car washes, all doing pretty well. So great up until middle of March. Since then, it's all changed, and we'll talk about that a little bit more this morning if you roll my next slide up. So I'd be remiss if we didn't talk about some of the good news that happened. River Landing, some of you know, is a Zephyr Egg property, or the Linville property, closed to Taylor Morrison and Horton. The former Rooks Dairy over on 301, just north of the new 56 interchange, under construction as of a week or so ago. I saw equipment still on the job. Marada, up the old Cannon Ranch, for the old timers. New Clinton Avenue, which is State Route 52, underway going through it. Closed a hospital site for 20 acres out there. Over on Long Lake, the Jurassic property at Long Lake in 54, they had a nice closing of over 400 lots for Mattamy Homes to be developed. That's underway now. And of course, the big granddaddy of them all, I guess, in Pasco County, Angeline, the Lennar Metro venture, had a couple really nice pieces of information. They sold 800 acres to Moffett for future research park, 800 acres to ELAP program in Pasco County to preserve land. And then maybe the best news that the 21 or 22-year-old long-running Army Corps of Engineer permit finally got granted for the extension of Ridge Road through the middle part of the county to provide hurricane evacuation all the way over to 41. That road is under construction. So lots of good things were on the first two and a half months of this year that I think is worth taking a second to celebrate. And some of the stuff we were talking about was follow the money. We had a lot of discussion underway here in the first quarter about moratoriums in parts of Hillsborough County and impact fee changes down there for schools. And had a, as I prepared this slide in early February, we're going to talk about the opportunities in Manatee County. Hernando County, for the first time, new home sales exceeded $200,000 average price. And we thought there was opportunity in Zephyr Hills and Plant City, still do, to stretch our legs a little bit to a couple of the local municipalities where maybe they had lower impact fees and would welcome, especially first and second time home deals. So that was some of the strength up through mid-March. In other areas, Eisenhower is the hot hand down in Eisenhower Properties in South Hillsborough County. Neal Communities, I think 7 builders in their northern Manatee community that's underway. Winfield South, back up in Pasco County, you may know is a Sugar Dance property under contract, and we had been at that point close to closing, see how that all plays out. And then the big one, Two Rivers Ranch, as I say, ranch is in the dance. Some news breaking there right before, I think on Friday the 13th, actually. So we'll see how that plays out down the road. And when I try and look at our perspective, for us, as I say, St. Patrick's Day, the bell rang. Is wow, okay, things are changing. But we look at the perspective of 2008. Some of you may not have been in the business or been in graduate school then, but we had a Wall Street meltdown where the Dow lost over 50%, and things that were institutionally shaking. Lehman Brothers filed Chapter 11, went out of business. Wow, a venerable 100-plus-year-old Wall Street firm. General Motors filed Chapter 11. It took TARP money and fundamentally changed that company. Many banks found that their loans failed the stress test, and land especially failed the stress test, that the value was no longer there to support the loan, but there was nowhere to go. The music had stopped. You couldn't get out of your maturing loans. The banks wouldn't renew them. And it was a terrible 3 or 4 year period of time to work a lot of that out from those loans. And of course, unemployment hit 10% pretty quickly there in 2009. So it was pretty stressful. Hopefully this one is not as deep and as long. Maybe it's deeper, but not as long. I love Willie Nunn. We've been friends for years and years and years, and he calls me up and asks me things at times. But I've been getting some nice emails from Willie and what he tells his team over at Homes by West Bay. And some of these I thought were just worth sharing, that the old world is gone. Together, we're learning more about the new world every day. We're beginning to collectively understand that our way of life has changed. And like Zoom, GoToMeeting, and FaceTime, there's a lot of technology being adopted at an extremely accelerated pace right now. Virtual Spring Roundup, here we are. It's talking about changing pace and changing technology. Zoom is in. A month ago, I thought Zoom was some snowboard deal out in Park City maybe, but as we prepared internally to do a couple of Zoom meetings in our company, and Ryan, young guy, pretty smart about all this stuff, but he got some advice from his 6-year-old Ronan, who had been doing Zoom for 2 weeks at school. So, wow, watching this technology spring forward is pretty cool. We all have been working in isolation to some extent. Thank goodness construction has been declared vital and kept thousands and thousands of jobs on the payroll and things moving forward. Hillsborough County reported the other day on a ULI call, they had record permits of 736 single-family permits in March. And of course, some of you have done a really good job of creating virtual selling, virtual closings, virtual walkthroughs. So there may be some fundamental changes down the road in how you market and how you sell and how you deal with the public. We also think that there's just some huge fundamental changes coming in retail and some other things. Ryan and I and the other team members, Jack and Michael and Chris, we're doing probably 2 webinars a day just to try and learn from others all around the country what's happening. But think about retail and think about the poor folks who spent 10 years building a great restaurant, getting a chef, getting the line cooks, getting the wait staff, getting the location, getting the menu, getting everything working, and then have all that blow up on you. I'm not sure I know how we replace that, or how quickly we replace that, or how quickly any of us are ready to go back out and have a meal in a restaurant with strangers sitting less than 6 feet from us. We've heard a number of seminars too on office. Some think that office will change because employers are going to look at the cost of occupancy of $50 a square foot per employee and go, this is a pretty good deal. Our people are working from home. We can cut our office space. Others who have been working from home for 2 or 3 weeks and maybe at home for a couple of months are going, man, I can't wait to get back to the office. But we think that if people go back to the office, they're going to want a cleaner environment, bigger space, more distancing from their fellow employees, not that little 100 square foot formula or 75 square foot formula that had been in place for employees for some time. So that's going to change. And think about travel. How long, once we open up, how long do you feel confident that you get on a plane, fly to Chicago, have a meeting, fly to Denver, have another meeting, go have dinner, come back the next day to Tampa, been through 3 airports, 2 or 3 airplanes, I guess 3 airplanes in that connection, and meetings with people that you don't know or where they've been. It might take a while to build some confidence in the travel. But at the same time, I've talked to folks like Pat Gasaway over at Height that we may be able to do more meetings in the future because we've gotten comfortable with Zoom. Why all jump in our cars and trucks and drive out to Height's office when we can do a Zoom meeting and save all that travel time. So I think there'll be some changes in that, and travel's going to have a long ways to go to get back on their feet as an industry. And how about large gatherings? I mean, think about the things that have been canceled, the Masters and the Indy 500, all those great things that go on in sports and gatherings around the country. My question will be, do you think we'll have enough confidence to go watch Tom Brady play at the Bucs Stadium come September? I don't know. We'll see. But I do think that some of the fallout that we're going to see is we have to rethink some land use and zoning requirements and classifications. For example, when this is all over, what are the new regulations going to look like that we need to serve office of the future, not office of the past? How about employment centers, and particularly Pasco County, where we have that designation that required certain percentages to be office and so forth? I think some of that has to be rethought once we know what the long-range changes are of this meltdown that we're in and the emergence back out of it. Shopping online has changed for every generation, and I'm a good example. I'm a person who didn't do much shopping online, but being confined here to my little 10-acre ranch, I now have a new leaf blower because one blew up on me. Came online, delivered a couple of days. I got a new pressure washer yesterday because my last one blew up on me also. Came, truck delivered to the barn, unloaded it, assembled in about 15 minutes. That just saved a couple hours of going to Tractor Supply and back and trying to manhandle the pressure washer on and off my pickup. So, I'm learning that maybe life's a little easier. We've bought some groceries online, and of course, the restaurant industry is trying desperately to figure out carry out food service for folks. So I think that'll change a lot. We were on a conference call where JLL, the big international brokerage firm, said they're leasing millions of square feet of distribution across the country every week. That all of the new services that we stay-at-home people need and want require a lot more space, and companies are making commitments for it and taking vacant space that's available. I think the distribution and industrial world will fundamentally be changed as a result of this. And how about schools? So when this is all over, will we continue to have virtual classes online? Maybe. That might be one solution to school concurrency and school capacity and school crowding, is that maybe part of our students, part of the time, stay home and take classes on Zoom, less pressure on the physical facilities, and less cost to provide the education, perhaps. I think we're fortunate. We have a pretty good infrastructure for our wireless networks. I've read and heard online that there's some disasters across Europe because of the stress on some of those systems, but we seem to be in great shape here. I think on a local level, we've done a pretty good job of figuring out these construction inspections, requiring the planning. I've heard from several builders telling me that they can't do customer warranty service, but they've converted their customer warranty people into coronavirus compliance officers, helping to arrange, make sure that houses are available for the inspections, no trades are in them, limiting the workforce to 5 people in the house at a time. But I'll tell you, if you watched the news last night, the media is paying attention, and they're showing the examples of 2 workers in a lift bucket, or 3 workers handling a pane of glass high up on a building in downtown Tampa, or 6 workers lined up behind a lunch truck out on a job site somewhere, and their neighbors are complaining about it. So I think the industry has done a good job, but we just got to be vigilant that we don't lose our status as a preferred industry here. And some of the early signs, we're only in this thing a month, and here's a big company called Redfin Realty, laid off 41% of their agents. A Wall Street brokerage firm that was formed basically to be a virtual real estate residential firm went out of business, with Chapter 11 a couple weeks ago. So we're seeing some distress already. There'll be a lot more changes that happen in our industry as brokers too. Job sites, so we've heard videos where in Denver, a builder has one of his OSHA compliant people now takes the temperature of every worker on job site, records in a book. If you got a temperature, you're going home. They're fogging their homes before deliveries, and the last person ends the fogger before the homeowner walks in. There was an interesting side comment on that particular one saying, oh, great. In about 3 years, the law firms will show up and be suing us over whatever we use to fog, much like they did over Chinese drywall and some other things. So yeah, I guess one solution is another man's downside and an opportunity for litigation down the road. But just a side note I thought was interesting. So we live in a world of a lot of information overload. It's almost hard to watch the news these nights because there's just so much flowing information about what's happening. I guess today's big headline is we're not going to fund WHO, the World Health Organization, and that's got everybody stirred up. So what about new deals in our marketplace? Well, we're seeing a couple of ours trying to make it through process, go to contract, but for longer inspection periods. And part of the extension is we don't know how long it's going to last in the down market. And secondly, we don't know what the process is going to be to get all the due diligence contractors on site, surveys, et cetera, and then to get before any of the counties and have the meetings you need and so forth. But I will tell you that developers, builders, home builders, apartment developers all think they're going to see lower land prices. Haven't seen any landowners say that yet, but we do hear from everyone else thinking that land prices are headed downward in this as a result of this. And we also have talked to some of our developer friends in the residential business. They're putting on downward pressure on development costs. They'd like to see a 10 to 20% downward push on land development costs because they think it's coming on housing pricing, and they think that their contracts to sell lots will have downward pressure, so they've got to get some cost out of the process. And a lot of builders too tell us they're not building any new specs. It's a control of cash situation. Other builders tell me that they're ignoring their takedown schedules, but they are taking down lots from their developers if they have a pre-sale. These are kind of temporary things, I think, until we figure out how we restructure. I do hear from my residential developers that there's a lot of downward pressure on their contracts. Some of the other builders, and I've talked to probably 20, and then we'll talk later on. Ryan's done a written survey of both builders and apartment developers, and he's going to share it with you. But the big pause, we're in a 60 to 90-day period of pushing. Every time you bump up against a deadline for inspections, periods, initial inspection or second step inspections or closings, the big push to push those out, hold on to cash. Cash is king. We are finding that in some cases where we extend closings, that the negotiations result in some deposits being released or some consideration, not just a freebie in most cases. And a couple of my builders have said, I think we're going to be in great shape when we exit. The builders have made a lot of money. They have a lot of cash. The thing, if this doesn't last too long, we're going to come out of it stronger than ever. Many builders expressed to me that they were scarred with the 08 and 9 and 10 period of time, to the point that they've been very conservative, and they continue to be very conservative in this process. So we should come out of this in good strength with our builders. Others have said to me they think there may be a couple of builders that won't make it in this market. They haven't put any names on anybody, but just everyone's a little bit suspicious about whether they can all survive. We did have some good news. We talked to some of our apartment folks, and their April 1st collections were much better than expected. In one case, they've collected over 90% of their April rents already, and that the collections in Tampa are far better than they are in Orlando. Of course, now the big worry is, where do we go in May? And there's an urban myth you don't have to pay rent. That's not exactly true. So some landlords are having to educate their tenants on that subject matter. Again, apartment guys as well as everyone expect the land prices to go down in this deal. We are hearing from most of our builders that the active adult market has really slowed down, partly because they're busy watching CNN Financial, watching their stock portfolio go down. They're not here. They're up north. They can't sell their house up north. All the stories that may be related to them. And the active adult market, or the target market, to those who should stay in, and maybe a little less adept at doing virtual purchase of a new home. So several reasons might be pushing that active adult thing a little slower. One builder shared with me their concern about having virtual hearings. They keep being told that maybe sooner or later planning and zoning departments can get around to having virtual hearings. That builder's concern was, well, how do we assure ourselves if we have a zoning hearing and we get through it, that 6 months later we don't get a lawsuit from an activist group saying, hey, we really didn't have our voice heard at the hearing, we want to reopen the case, we want to appeal, or we want to do something that upsets your apple cart further down the road. So just a concern that builder shared. I had another builder to do affordable housing, said March was their best month ever. Their big concern is more the supply line. Do building products get through the ports like Los Angeles? And if they get through the ports, and is there enough labor force out there? Do they get delivered by rail or by truck to Tampa and then distributed to job sites? So that was kept them up at night thinking about that. Again, another developer just stopped residential land development a couple of weeks ago in their subdivision, said not putting any more money in the ground. My builders want reduced pricing. Why would I put more money in the ground until I know what my lots are going to sell for and who's going to buy them? So they're the ones expecting downward pressure on cost to develop. Again, workplace compliance is a big issue. You guys know that. And a big shout out to Jennifer Marsinger and the folks over at Tampa Bay Builders Association. We're working with Hillsborough County and getting permits, getting inspections, getting COs. So congratulations. Another builder, and several builders commented on that, by the way, Jennifer. So good job. And another builder commented to me that they see credit scores they believe are going to jump from 580 to maybe 680 or 700. They think that's a huge snag in the marketplace if that happens. So we'll see. Along credit lines too, I had one of the CDD management companies share with me, the CDD market's basically stopped. Not that there's any necessarily demand or issuing any bonds today, but the rates kind of jumped all over the place, settled out, and they think it's another 2 or 3 weeks or a month before the rates will sort out and before somebody really needs to do a CDD issue anyhow. So just a little bit of uncertain there as to what happens with CDD financing down the road. So that kind of wraps up my thing. Again, I want to thank my team, and I want to thank all the folks who helped put this together this morning. I'm going to turn over to Ryan Sampson, the principal, and let Ryan run the next segment of the program. Thank you all very much for joining in. I think we have a Q&A session. This is being recorded, so at the end, we'll give information on how to get it if you missed part of it or you need it for your team later. So we're glad to be here from Eshenbaugh Land Company, and call us if we can help you. Ron?
Great. Well, good morning, everyone. Hopefully you can hear me okay and see the slides. Eshenbaugh Land Company, again, is proud to be partnering with John Burns and presenting you this information. Just a couple of quick housekeeping items. If you click on the bottom, there's a Q&A section that you could pop open that bar and type in questions, and we will try and answer them either during the program or afterwards. We'll open it up for Q&A. Additionally, this is being recorded, so we're happy to provide a link afterwards if anybody would like to watch it or missed a portion of it. Happy to provide that, as well as the slides. So feel free to reach out to myself, Bill, or Leslie, and we'd be glad to get you those. So we're in an ever-changing world. It seems like every day something new is happening. And so Monday we sent out a survey to both home builders and apartment developers, and just wanted to give you guys at least what the feedback was as of Monday. So I'll quickly run through those results and then turn it over to Leslie to provide what she's seeing on a more national level. So first question we asked was on land acquisitions contracted prior to March 15th. We are on hold, was the majority of what folks are saying now. We're seeing a lot of people asking for 60 to 90-day extensions. Have not seen many deals terminated, though there have been a couple that were under a tight time frame and weren't willing to take that risk or work out an extension, but the majority of people are extending, or if they had already internal approvals and were far enough down the permitting process, they're closing in 8 locations. So it's interesting to see what the builders are saying. None of the builders are terminating, and none of them are off-booking deals, which I find is interesting because that's not necessarily what we're seeing. There are off-book groups circling. So before terminating a deal, if there is any interest in talking to an off-book group that would close it and then feed you lots back or give you a right of first refusal, we're happy to make those introductions as well. We're getting calls from a ton of groups. Next question that we asked to the builder community: when it comes to new land development opportunities, we saw the majority of folks saying they're continuing to contract sites, but looking for more time and a lower land basis. It's interesting. There's groups now going back to we don't even think we need to put up a big deposit. So we'll pay their price if they'll give us our time. A couple of the private builders or smaller builders said that they're looking at trying to grow their market share in this environment. And if big builders drop sites, let them know. They would be all over it. But you can see the majority of people are still business as usual or trying to just continue, but not necessarily terminating or stopping new development land opportunities. We were interested about what's going on in the model homes since April 1st. Were they open, getting traffic? And so the results are majority of people are by appointment only or virtually. And 15% say that your models are closed. I assume everyone's are closed except for appointment or virtual due to the rules. But that was an interesting response, that there was zero response open for business as usual. So interesting there. Next was April 1st. Our sales are down 50%. That was down 25 to 50% was the majority of the folks. Only 11% said they were on pace, and another 11% said they were non-existent or basically it stopped. A couple of the folks we talked to that have a presence in Orlando just said it's been devastating to have 15 sales 1 month in a community, and now we're lucky to have one in Orlando. Tampa, I think, is faring a little bit better due to the job base and not as heavily reliable on tourism. So construction costs, we asked what you're projecting, and most are saying stay the same, about 60%, 30% decrease, and only 6% are saying that it's going to increase. So we think that's going to be the push, is trying to push down construction costs and land costs. It's just, see if the landowners and the contractors, how desperate they get to feed that request from the builder community. Sales prior to March 15th, what percentage do you think are actually going to close now or have closed? We're a month later, and it was pretty good number, I thought. 40% of the participants said 80% or more are closing on time. 30% said 60%, and only about 5% said everyone's closing. So I guess it's more of a broader question, depending on what segment of the market you're in, whether they're concerned about their job or just their net worth. So that's probably driving less decisions. Again, on those sales prior to March 15th, what percentage of your buyers have been laid off or furloughed? And again, this is for the buyers, not employees of the builder, but 5% seemed to 5 to 10% made up more than 50% of the responses of people. So that national unemployment rate we expect to go up is only going to continue to affect home sales. Sales prior to March 15th, what percent do not qualify for financing today? As Bill alluded to, we hear that credit's getting a little bit tighter with FICO scores, and people are using their down payments to live. And so it was interesting to see almost 80%, 75% now don't qualify. So, or should I say 70% of the people said 5 to 10% of their buyers don't qualify. So 5 to 10% seems to be the thing that this is affecting. In the first month of coronavirus, it's affecting 5 to 10% of the buyers, and you'll see in the apartment business it's the same, and we'll see how it goes next month. So short-term future for the Tampa land market. That's always important to some land brokers, and 70% said yet to be determined. This uncertainty is out there and trying to figure it out day by day. Only 23% said it's too expensive. So that's good. Good for us. And we're continuing to get new land contracts, though everyone is a little bit more cautious. So I think this was the last question we asked the home builders was in 6 months, the USA will be, and 50% are open for business with under 9% unemployment. 40% open with business for, over 10%. So 6 would be in a recession, but I found it interesting that no one thought we're going to be in a depression, and no one thought that we'll go back to normal. So hopefully 6 months from now, we're all having a little bit different conversation, and we are back for business and cheering to a happy 2021. So next, we did a quick kind of survey to the apartment developers as well, and so we'll see what their thoughts were. We asked about April rent payments, how many of the tenants paid in the apartment market, and 5 to 10% was kind of the number. So almost 80% of the respondents of these apartment owners and developers said, less than 10% or less continued to pay or missed their payment in April. So 90% is pretty strong. May, let's see, what do you expect in May with the unemployment numbers coming out weekly? So historic, and the bigger jump there, they're expecting mostly 15 to 20%, not making their payments in May. So we'll see how that plays out. When it comes to new apartment development, where are they? 56% are still looking to contract sites similar to the home builders. 28% are on hold for new acquisitions. I'll tell you, in the last 2 weeks, we've had probably 10 apartment groups call us, say, if anybody drops a site, we're ready to go. We want to be in Tampa, and we've got funds. So, whether that's accurate or they're just saying that to try and tie it up and start the clock all over again, we'll see. But there's groups out there looking for someone to do it. So I'm reading some of the questions, so I'll try and answer these as well. Mr. Dady mentioned my nice beard. It's kind of interesting, the Zoom calls that we've been doing. A lot of folks out there that are working from home are growing beards these days, not getting their hair cut. So I'm sure there's some of you out there, and it's kind of fun to be able to do something a little different. My wife hates it, but that's okay. So back to apartments. Since April 1st, the traffic to lease new units down 70%. 70% of our respondents said it's down 20 to 50%. 19% have said it's more than 50%. So pretty interesting, not unexpected. But if you're an apartment developer that's getting ready to deliver a new project, your lease up's going to be tough. You hope you just started construction. So new development deals today. The biggest concerns for apartment developers is construction financing. That has been the big issue. We had a deal that was supposed to close next week. Supposed to close 3 months ago. They had their financing set up, waiting on a plat to be issued. The plat was finally issued April 7th, triggers the closing 15 days later, and their construction lender just walked. And this is a group that's done, nationwide apartments. And that's, I think, the third deal we've had blow up apartment, just tied to the construction lending, basically frozen. So it's interesting that here we go. They've got the equity. They've got the experience. They're not going to deliver a project for 18 to 20 months, and yet the lenders have put them on ice, or are tightening up their underwriting, requiring much more down payment and lower rent projections. So construction lenders, they say they're still funding deals. This was as of Monday. Temporary and hold. 0% said stop funding, but as we've seen, 3 of our buyers have said they've stopped funding. So it's interesting what's real and what the apartment developers are saying. So maybe your lenders are telling you they're funding until you go to fund it, and then they're backing out. So new deals being underwritten. So for the apartment world, I asked what they're building to today or underwriting to today. 60% are between a 6.5 and a 7% return on cost. 33 are still a 6 to 6.5. Prior to this, we had some folks, and it was rare, but say that they were just under a 6 or just over a 6, which was a pretty tight deal. And so now it looks like 6.5 to 7 is where most people are. And some folks are now over a 7.5 return on cost yield. So interesting. Future of the apartment land market for Tampa, again, similar to the home builders, yet to be determined. Only 23% said too expensive, which I'm sure they're saying that just to try and get that beat that in our heads to try and get us to lower pricing. But strong fundamentals, only 6%, but nobody said it was oversaturated due to the supply pipeline, which I found shocking based on what you read and all the units we know in the pipeline, that no one thinks it's oversaturated. So, and then lastly, again, asked what the apartment folks thought in 6 months, where will the US be? And 47% open for business, under 9% unemployment, and 41 over 10% unemployment. So similar to the home builders, 0 in a recession and 0 in pre-COVID fundamentals. So that's kind of where we are with the new world. A couple more questions I'll answer, and then I'll turn it over to Leslie. Bill, maybe we'll direct this one to Bill afterwards, but it's about construction costs and why they're going down. We'll direct that one to Bill. And then lastly, this one from David Lang. I want to know how many people responded to these surveys. It was about 30 respondents to each, and that was from Monday. And we sent it to probably 100 or so of each, and about 30 responded to each, give or take. So that was kind of where we are. But with that, we'll turn it over to Leslie, and then after, open it up for more Q&A.
Okay, thank you. Let me get on the screen here. Okay. Thank you very much, Ryan and Bill. And I'm thinking everyone can hear me at this point and see my screen. So I'm here today to take a little step back and to look really across Tampa, across Florida, and across the US. So I titled this presentation Through the Looking Glass. And really what I'm planning to do here is provide that different perspective for all the different people we have on the call. So for home builders, landowners, developers, as well as the industry. And it is certainly an interesting time, and there is an interesting perspective. I found a lot of help from Alice in Wonderland here. It's no use going back to yesterday because I was a different person then. And that kind of sums up where we are in this particular cycle and with this pandemic. I'll start really at the highest level I can. We at John Burns are talking about 3 different crisis timelines. A lot of the questions have been, when do we get back to work? When do we get out of our houses? But really, we have to focus on these 3 specific timelines. One, you've got a global health crisis with very different severity by geography. The second timeline is the US economic crisis that varies by industry and also by geography. And then we have a housing crisis and you can see that from a lot of the surveys that Ryan said, and I've been talking to builders and developers, apartment owners across the state and the region. Really, a lot of people are cautiously optimistic and don't believe that the housing industry crisis will happen. So let's go through some of these things. In 2019, we did have red flags on the economy everywhere. It was a good year for housing, but we also had some worrisome aspects of the US economy. We had a record high stock market, record high level of junk bonds, unicorn valuations, a record high auto debt, student loans as well, and non-bank mortgages. So with all of that, we were concerned about a potential recession in 2019. The market got markedly better in early 2020, and then we hit the coronavirus stopping point. What's really interesting though is in 2010, our company did a white paper, and what we did was we looked at all the different sectors of the US economy. So if you divide it out by sector, and typically a recession happens by borrowing too much debt. So this is the debt that was borrowed by each sector from 2009 to 2018. Look at technology, look at the red bars in technology and electronics and healthcare. These were the sectors we were worried about. The green bars represent the GDP growth of that sector, and the blue is the job growth. So you tend to be borrowing a whole lot more than you were producing. But if you go down here to the bottom and look at real estate and home building and building materials, we're coming into this downturn, and we are in a recession at this point, but the real estate sector is coming in much better shape than other sectors of the economy. And as you've heard over and over again, and I think what's really going to be important in the recovery cycle here is cash. Liquidity is the number one word. Cash is king here. And the public builders have debt, but look at their bond maturity timelines. It's way far out there. So they're in a much better position to weather this downturn than they were obviously during the last downturn when the home building industry was part of the whole problem here. So I have talked to people really across the country, and one person said to me, I'm happy I'm in the home building industry. This is the place I want to be. I want to be in residential real estate, because this is going to be the sector that can actually weather this. And part of that reason is the cash. We do have some major issues ahead of us. And I think we haven't even started going back to the timelines. We haven't even started to see the true impact of this. This shows you that more than half of small businesses in the US said they wouldn't survive 3 months if sales stopped completely. Now, the payroll protection program is helping a lot of these small businesses, but they're paying the wages. They're not necessarily paying the rents, which is not going to help if you're living in New York City or working in New York City. And so they're still going to have some major reverberations. I mean, we've already hit that 1 month period. We're down to that 1 to 3 months, with over half those small businesses are going to be in trouble. And then we look at the people. We're not a savings type of society here. The US savings rate's pretty low. So 50% of workers say they're basically living paycheck to paycheck. They can't skip a paycheck. They can skip one. A total of 50% can skip one. And then you really have started to see that come to play with our picture that I'm sure you have seen in the past of the weekly initial jobless claims. Those numbers are really jarring. And I will say that once we started to see these numbers come out and the size and the magnitude of these numbers, the pace of recovery in our minds started to get further and further out. You can't rehire 12 million people in a day, in a month, and in 2 months. That takes time. So there's going to be some serious fallout yet. And I think we're just kind of on the cusp of that. Now, it's going to vary based on where you are geographically, and obviously what cycle you're in. One of the first indices that we put together, and this is based primarily on employment, but these are the sectors that were hit the hardest right away. And then we went through all the different markets to look at their percentage of employment for all of these sectors. Active adult is on there a little different. We did that for the home building. That one was a little bit more qualitative, but also counted the number of active adult communities and retirees per market. So green means that they really don't have they really have a small percentage of their economy based on these sectors. If you look at the reds in Miami and Orlando, they're getting hit on multiple fronts. They're getting hit on retail trade, on the ports, on the cruise industry, on leisure and hospitality. Tampa is definitely up there. We kind of gave them that red flag for the active adult, the retail trade, and the cruise industry. But I want to take a step out of this box, if you will, and look at Tampa's economy, because more and more that I talk to people, to builders, to apartment owners, to landowners in Tampa, it seems to be a little bit more optimistic. So I started to think about it, and I think part of that is who Tampa is really the economy of Tampa. Look at your largest employers. These are all employers that aren't going to be shedding jobs anytime soon because they're part of this new economy. And then we take the largest industries in Tampa and you sort them by employment. Food and services is typically the largest employment sector, and there's no doubt there's going to be some serious distress in that sector. But look at insurance carriers, credit intermediation. These are sectors of the job force that are going to continue to add jobs. So I do think Tampa's economy is set up better than most. They're still going to have the impact of this downturn pretty severely, but they are set up better than most here to weather the storm. I'm going to start with the home builders. Every adventure requires a first step, said the Cheshire Cat. These are all quotes to live by here, and very apropos of the times we're living in. We do real-time data. One of the first things that that John Burns decided when this started, when the COVID-19 crisis really shut down the economy, was to hold off on our forecasts, because you can't see in front of your face at this point. You can't see a day or two ahead. We are working on our forecast now and should have them by the end of this month, which it give us a little bit more clarity. But right now it's just a pure guessing game. So we do have end of March. We surveyed builders all across the country. This represents about 15% of all new home transactions in the country. So there's hundreds of builders that are being surveyed here. And what we found was that, yes, sales were down about 5%, which doesn't look too bad. On the whole, for the hundreds of builders that I've been speaking with, the first 2 to 3, maybe 3 weeks of March were pretty strong. And then it really started to fall off a cliff. So that's what you're seeing here. I'm sure the April numbers will be much more significant. Cancellations across the country were definitely rising. You can see that rise in March, and that happened towards the end of March. We expect it to rise much further in April, but 13.9% really wasn't too bad. Builders are working extremely hard on their backlog. And I think that's part of what's going on here with this optimism, is that they're so busy working on their backlog. But what I've heard week by week in April is that the sales are stopping at this point. It's very, very slow. Florida builders are a little bit different. So that was the national look, and then I kind of narrowed it down to the Florida answers. We did see a 5% new home price increase. That was the highest percentage of all the states across the country. So that was in March. I think part of that is due to our late, in Florida, we had a later shutdown of the economy than, say, California and the Northeast. But 5% increase in new home prices against a 2.4% cost increase. So really March overall was a very good month for the Florida builders. The one indicator that was rising in Florida that was not rising in other parts of the country is the spec homes per community. So we averaged in Florida about 2 spec homes per community, which was one of the highest rates across the country. And a lot of that has to do with the strong home building market. And Florida was really roaring along on the home building side until the COVID-19 hit. Cancellation rate in Florida was 10.9%. And remember back the US was 13.9. So again, it's lower than the US. But I will say this varies tremendously by region. If you look at Jacksonville, they had the highest cancellation rate, about 38%. Orlando was 30%. I'm sorry, and Tampa was down to 10.9. So what we really think is going to happen here is that the home buyer is going to change. There's going to be some serious preferences that change out of being in your home for a month or 2 months or however long this lasts. And what's going to be important for the builders is to look at who your home buyer is and what their experience has been and what they'll be looking for next. So if you look at the first time buyers, they're not going to have a whole lot of job security. So my guess is where they're going to be looking is going to be closest to their job. They have a lot of student debt, but they're going to be most comfortable with the new technology that the builders have been using. So they're going to be the ones that can buy a home online and can use that technology to its fullest. The families are definitely provide a large amount of opportunity. They've probably got a lot of cabin fever at this point, and they're looking for a bigger home. So we were downsizing before this, and we're probably looking for larger. They're looking for their separate spaces. And so they may be motivated for that newer home. And finally, the retirees, they are definitely more sensitive to the stock market volatility. And Ryan mentioned, I think Bill mentioned the active adult really slowing down, and I've seen that too. A lot of that has to do with the stock market volatility. But the 55 plus segment of the market are going to be less comfortable with the online tours. So there's still going to have to be that happy medium that's going to have to happen after we get back out to work. And they also probably have a home to sell. So the health of the resale market is going to matter significantly. And finally, for the home buyers, I think I've heard this along the retail sector and the office sector as well, is that this pandemic has done, if it's done anything, it's done one specific thing of accelerating trends. These are trends we were always talking about happening in the US, and now that we've really hit the acceleration button here. So the old way of selling homes were the multiple furnished models with the pricing on the website from the 200s, the 300s. You drive your traffic volume to agents sitting on site. Floor plans and photos are online, and then the sales offices are open 10 to 5. I think there's going to be a new way here. And the new way is going to be, you're going to have fewer models. Some of them might be unfurnished because people might have different ways of using their space. Real-time pricing on the website, you're going to see online buying. There's builders that have started the full online process, and I think that'll proliferate. Self-guided tours with different hours. And then the internet sales staff, which has really been vital in this environment, is going to start pre-screening. So you'll have better qualified traffic. And that's what's happening now, and I think that'll happen in the future. Some other trends, I think the new home industry is poised well to take advantage of the new home as a healthy home. So a new home, like they talked about the fogging of the homes, it's the cleanest home you can get, and health is going to be paramount on people's minds when they get back out into their home shopping experience. The home office is going to come back in a big way, whether it's small and it's just blocked off slightly. But not only the home office, but the office for the children, for online learning. I think that's been a very big trend that's been accelerated, is that kids can't sit at the kitchen table and do their homework. They're going to have their own space for it. So looking at the current models, spec models that are out there, and building new models, is having their own space for their work is going to be very important. And finally, multi-generational living. I think this was a trend that we saw, that we spoke about prior to the pandemic, but I think it will accelerate now, the importance of having either your oldest child come back because they do not have a job, or again, your parents or in-laws coming in. Moving on to the land market. Why sometimes I believed as many as 6 impossible things before breakfast, says the Queen of Hearts. So let's move on to the land. We do a land broker survey across the US. Really 3 things are coming out of that. The biggest thing, and I think Ryan covered this well, and I won't spend too much time here, but it's all about extending at this point. 30 days seems to be the norm. 60 days is popping up more and more. I've heard some points of 90 days, which usually gets a lot of pushback, but we're really focused on not renegotiating prices, but extending out the timeline. Based on Florida, very similar to Ryan's surveys, we've got over 50% on March 1st said they were expected to close on time. Ryan did this in March 15th, and I'll bet you that this number started to come down a little bit. I think the most important thing for the land going forward is to look at your geographic opportunities. So this is our map of Tampa, and what it shows here is purely based on the most desirable place to live, not on where the land is. Or not where the home prices are, but this is where people would choose to live if they, irregardless of land and home prices. This is based on crime, on median income, on schools, on proximity to employment. And I think out of this, I think you're really going to have to focus on which pieces come back first, where the demand is. If I'm willing to take bets, it's going to be places that are close to employment, because everybody has been affected in their job at this point, and that's not going to go away over the next few years. So the people that are buying homes going in the next few years are really going to be focused on where they're working and how they're getting to work. So just something to think about for the land. And now I'll turn to the rental market. The Queen of Hearts also says, she has a lot of good quotes, "It takes all the running you can do to keep in the same place. If you want to get somewhere else, you must run at least twice as fast as that." And I think that's really apropos for the rentals, because the rental market is going to get hurt the most by the unemployment numbers. So we do Google search phrases, and you can see the blue line shows the search phrase by day of unemployment. And as that goes up, so do the unemployment claims. So really the first group of people to lose their jobs were really the renters, were the people in service industries and tourism industries, and a lot of people in this state. And this is really going to have a strong impact on the apartment market. We also look at Google searches. These are real-time searches through April 5th, I believe this is. And it shows the number of people searching can't pay rent versus can't pay their mortgage. So this really brings out, and I know we've started to see some people that cannot pay their rent. I think that number is going to be increasing over time. And I think that the rental market is going to be in for some distress at this point. Not all of it, not every single property, but we are going to see some concern here. Part of that has to do with the construction. Ryan alluded to it, and I had to bring it up here. These are multifamily permits in Tampa. The 20-year average is about 5,500. Tampa hit about 9,000 last year permits. So we clearly are at the height of our permit activity. But I will say, even though the construction levels have been high, the actual market is pretty strong. So the current vacancy rate in Tampa's apartment market is 4.8%. That is really low. If you look at the 20-year average vacancy rate in Tampa, it's 6.1. So I believe there's going to be some distress. There has to be with all of the job losses in the US, but I will say that Tampa's apartment market is starting at a much better place. And although we haven't come out with our forecast yet, I'm willing to place some bets that you are going to see some major rent declines. This was in Tampa, and you just pull up on their websites, on these apartment websites, what's happening now. These are concessions, incentives, whatever you want to call them. They are basically starting to, I wouldn't call it panic, but there has got to be, for the properties that are in lease up, it's going to be very hard to get them leased up. And there's going to be some competition because people are going to have to move back in either with their parents or within each other and start to double up because the job market is very, very uncertain. So this is the beginning of the rent declines, and I do think that'll continue. The apartment world will be changing for sure. Virtual leases are going to be the new reality. The apartment market was early adapter of virtual leases and virtual tours. So I think that's just, again, another acceleration of this trend. And I think location is going to be key. So there are going to be tons of apartments that outperform in this cycle. And we use the Suburban example here. Again, I go back to close to jobs is really going to be a big focus for people that have either lost their jobs or are holding on to their jobs or are moving to Tampa because of jobs. So I think apartments that are well located are going to perform better than the ones that are either way out in the suburbs or even, further away from where the job growth is. I talked about apartments a lot. I also want to talk about the single family rental opportunity here. I think this holds true for the apartment industry as well as the home building industry. The single family rental sector experienced a huge burst of activity in late March. Probably the only sector of the economy that really saw the increase in demand. And part of that was people leaving apartments wanting more space. So I think this is an opportunity for apartment portfolio owners to expand their portfolio and have a diversity of offerings, but also for home builders to start considering moving into this space. And I know there's a lot of single family rental operators as well, but there's going to be a demand to have your own four walls, your small backyard. You might not have a job or you might be starting a new job, but if you have a family and you've lost your home because of this, single family rental is going to be a very interesting place to turn. So I think there's some real positive aspects to this type of industry going forward. So with that, I'm going to end up with our a push for our client base is getting a webinar. It's a webinar only for our clients, and it's supposed to give them a big competitive advantage every Thursday. So that's what we've been focused on. Yes, we suspended all of our forecasts, but we're still very, very forward thinking. And we're going to start to reinstate our forecasts, and that'll be done on our webinar. And again, that's just for our clients. We've also moved to more real-time data, and we're focused on that. We've moved to an online platform that provides more online, more real-time data, because that's going to be the most important thing ever. And again, that's for our clients only. But if you want free information, Ken Perlman and I are putting out every Friday. We spend all week trying to challenge each other to come up with a new opportunity here that's going to occur once we get out of our houses and we move on from the first phase, I guess, the first timeline of this pandemic. So we continue to find these new opportunities, and I think there will be a lot of opportunities. Timing is going to be very, very important, and we tend to follow across all the different sectors as this goes on. So with that, I thank you, and I will turn it back over to Ryan here to close us out.
Great. Well, appreciate Leslie and John Burns and everything that y'all have provided and hosted this great webinar. And the about 160 people or so that are on, we thank you. It's just after 12 now. Again, this has been recorded. We're happy to email you the slides. Just shoot myself or Leslie or Bill an email and we'll get those over to you. And if you'd like a link to the recorded video, happy to do that. And with that, it looks like all questions are answered, and we can go ahead and end it, I guess. So thank y'all.